Yeah, I've got three key takeaways here. First thing is when you just look at the totality of this is pretty much on spot on for market expectations. The statement all but basically admits to this is a pause. In the press conference, he tried really hard to not say that, but to say that, and I think it's pretty clear that that's where we're at. Second thing that I took away, I'll call it the new Powell arithmetic as to how he gets to the pause in that policy is sufficiently restrictive. And so what is that new arithmetic? It's the nominal rate minus 3% inflation gets you to a 2% real rate. Add to that credit tightening and add to that QT, and that's how he gets to sufficiently restrictive. And so I think when we look forward, it's really going to be the assessment on this arithmetic towards sufficiently restrictive. First of all, is 3% the right inflation rate to subtract from that nominal rate? If inflation stays high, that real rate isn't as tight as he's implying. Second piece is, and he admitted this, we don't really know the magnitude of this credit tightening. We only know the directionality. And the third piece is how much is QT really generating sufficient tightening in the real economy remains kind of very unclear. And the third key takeaway here, and he talked about this, and Mike McKee, great question because you got this out of him. What about rate cuts in the market? And he highlighted that's the difference between the market inflation forecast, which is a very aggressive decline back down to 2%, versus the Fed's forecast, which is for a much more gradual inflation decline. And that's what separates market expectations for Fed cuts from the Fed's reiteration again here that they will hold rates at this level for a long period of time in contrast to market expectations. So it gets us back to a focus on the inflation data.